Welcome to the Nifty Noon podcast. If you look at the headlines from our newsletter this past week, you might feel like you're watching, you know, a massive tug of war.
Oh, absolutely. It's a really intense dynamic right now.
Right, because on the surface, the headline, crypto markets are just sweating. I mean, we're talking about severe ETF sell-offs, cascading liquidations, and just red charts across the board.
Yeah, it looks like a classic retail panic, just pure short-term anxiety.
Exactly. But beneath that surface, deep in the bedrock, traditional finance and these huge consumer platforms are, well, they're quietly and aggressively laying the permanent groundwork for the next era of tokenized assets.
And everyday crypto spending, which is honestly the most foundational development we've seen in a decade.
Yeah, so for you listening, the mission of this deep dive today is to separate that short-term market noise,
Yeah.
the stuff that just spikes your blood pressure, from the massive structural shifts happening behind the scenes.
Right, because we want to help you stay ahead of the curve here.
Okay, let's unpack this. Starting with the macroeconomic mood setter for the week, which hit on June 15th.
Ah, yes, the ETF volume numbers.
Right, so our newsletter reported that U.S. spot Bitcoin ETFs are approaching a staggering $2 trillion in cumulative volume. $2 trillion.
Which sounds like the ultimate victory lap, right?
It does. But this milestone is being completely overshadowed by these massive net outflows and liquidations. It's severely testing investor conviction.
Yeah, it's a remarkably confusing signal for a lot of people to process right now.
I genuinely struggle to square this circle. To me, it's kind of like a blockbuster movie hitting $2 billion at the box office, but like half the audience is demanding a refund and walking out of the theater halfway through.
That is a perfect analogy.
Right. Like, how do we register this historic, monumental volume, but at the exact same time face plummeting investor belief?
Well, what's fascinating here is how we define volume versus how we define conviction. Volume simply equals activity.
So just shares changing hands.
Exactly. It does not inherently mean bullish belief in the asset. When a market is in fear, or, algorithms are rapidly trading, or over-leveraged traders are getting forcibly liquidated, all of that generates immense volume.
Wait, let me push back on that term, liquidations, because it gets thrown around so much. Are people just voluntarily deciding to sell because the price dipped?
No, it is entirely involuntary. Imagine a trader who only has $1,000, but they borrow $9,000 from a broker.
Okay, so they're highly leveraged.
Right. If Bitcoin drops even 10%, that trader's original $1,000 is totally wiped out.
Oh, wow.
So to protect themselves, the broker's automated system forcibly steps in, seizes the asset, and sells it at whatever the market price is.
Which pushes the price down further, and that triggers the next over-leveraged trader's liquidation.
Exactly. It creates this massive domino effect.
So panic selling and forced algorithmic dumps count toward that $2 trillion volume figure just as much as euphoric buying.
Yeah, it's essentially the market plumbing being violently flushed, which serves as a brutal but necessary stress test. It shakes out the passive holders and the tourists, but more importantly, it sets the stage for what institutional money does next.
Right, because institutional money doesn't just buy and hold forever.
No, they constantly reallocate. When passive holding stops being profitable, they look for active yield.
Which brings us to June 16th. If institutional money is cooling on passive holding, where is that conviction shifting?
Surprisingly, it's shifting to decentralized finance infrastructure, DeFi.
Right, because Standard Chartered, which is this towering legacy traditional banking giant, they projected that Uniswap's UNI token could surge to a $100 mega pump by 2030.
Which is just a staggering projection coming from a traditional bank.
It's genuinely shocking. Seeing a legacy bank hype up a decentralized exchange token feels like, Blockbuster openly investing in Netflix.
Yeah, back in 2005, it's a total paradigm shift.
So I have to play devil's advocate here. Is this projection just corporate hype, or is this an actual signal of a massive structural migration?
Well, if we connect this to the bigger picture, it is absolutely a signal of a structural migration.
Okay, how so?
Institutions are no longer satisfied with just holding digital gold in a vault. They want to actively participate in the yield of real-world assets moving onto blockchain rails.
Before we go further, for anyone trying to visualize this, how does an environment like Uniswap actually handle that kind of institutional volume?
So think of the traditional New York Stock Exchange as a matchmaking service. A broker has to find a specific buyer for a specific seller.
Right, and if no one wants to match your trade, you just wait.
Exactly. But a decentralized exchange like Uniswap uses liquidity pools. It throws the matchmaking concept out the window.
Okay, so what is a liquidity pool exactly?
It's basically a giant communal vault of two different assets, say a tokenized treasury bill and a digital dollar. The vault's prices are set by a mathematical algorithm.
Oh, so you aren't waiting for a broker to find a match.
Nope, you are simply swapping your asset directly with the automated vault. It's instant, guaranteed, and never closes.
But wait, how does volume inside those vaults translate to the UNI token hitting $100? Why isn't it just a useless governance token?
Because of value capture mechanics, specifically a fee switch.
Fee switch.
Yeah, token holders have the voting power to flip a switch that redirects a fraction of the trading fees directly back to themselves.
So if massive institutions are suddenly trading trillions of dollars through these vaults.
Even a microscopic fraction of a percentage fee equates to astronomical revenue for the token holders.
Okay, so if banks are predicting this huge on-chain migration, someone actually has to build the bridge. And that brings us to June 17th.
Right, Coinbase steps in.
Yeah, Coinbase announced plans to launch one-to-one backed tokenized U.S. equities. And here's where it gets really interesting. These feature automatic dividend payments, and they're specifically designed for international users.
We basically go straight from Standard Chartered's 2030 theory to Coinbase building the actual functioning bridge today.
Totally. And the international angle is huge. For you and me, buying a U.S. stock is fairly easy. But for a listener overseas, it's full of massive geographical walled gardens.
Oh, it's a nightmare. You deal with currency conversions, wire fees, clearinghouses.
Taking 3 days to settle, middlemen slicing a fee off the top everywhere.
Yeah.
Imagine earning an Apple dividend internationally. It's like trying to mail a physical letter through 5 foreign post offices.
Exactly.
But on a blockchain, it's like sending an instant text message. You earn that Apple dividend instantly, directly into a crypto wallet halfway across the world.
This raises an important question. What even constitutes a traditional stock exchange anymore?
Right, because Coinbase is completely blurring the line between a traditional stock exchange and a crypto platform.
Exactly, emphasizing the crazy efficiency of automated corporate actions running on smart contracts.
Let me make sure we have the mechanics right, though. That dividend payout doesn't come in highly volatile Bitcoin, does it?
No. It arrives as a stablecoin equivalent.
Okay, so like a digital dollar.
Correct. It's designed to hold its value at exactly $1, avoiding all those wild crypto price swings.
And the engine driving this is the smart contract.
Yes. Think of a smart contract as a digital vending machine. You don't need a human cashier. You put in the money, it verifies the conditions, and it drops the soda.
So the code just checks the digital ledger, sees who holds the stock at that exact millisecond, and routes the stablecoin. No 3-day delays.
Exactly. It's flawless technologically.
Let me challenge the regulatory reality of this, though. Politically, why would foreign governments, or even the SEC, allow citizens to completely bypass local brokers?
Well, they will certainly try to stop it, and we are going to see a lot of friction. But capital operates like water. It relentlessly seeks the path of least resistance.
The market demand is just going to be too overwhelming.
Yeah. Regulators can build dams, but they cannot uninvent the efficiency of the smart contract ledger. Coinbase is essentially exporting the liquidity of the U.S. equity market to the entire globe.
Okay, so that covers the high-level institutional plumbing. But moving to June 18th, how does the everyday listener actually spend this value at the grocery store?
Right, bridging back into the physical world.
Because our newsletter highlighted some staggering developments in stablecoin card infrastructure. A company called Rain introduced on-chain rewards, and monthly crypto card spending violently surged past the $600 million mark.
$600 million a month elevates this far beyond a novelty. That is entrenched consumer behavior.
So what does this all mean? When I look at on-chain rewards, my mind jumps to traditional credit card points, airline miles, hotel points, the ultimate TradFi loyalty trap.
Oh, absolutely.
Are they just copying the legacy banking playbook, or does doing this on-chain actually change the game for the consumer?
It fundamentally changes the math, and it's the ultimate sign of market maturity. The underlying mechanics are radically different from legacy finance.
How so?
Think about airline miles. Those are classified as liabilities on an airline's corporate balance sheet. They can devalue them at will.
Oh, we've all suffered through that. You try to book a flight, and your points are suddenly worth half of what they were yesterday.
Exactly. But with an on-chain reward, you possess a sovereign asset on a public ledger. The card issuer cannot arbitrarily expire it or devalue it.
Okay, but let me play the skeptic. If I get Delta Sky Miles, I know I'm booking a flight. If I get some obscure on-chain token, isn't that just a massive cognitive load for the average person buying groceries?
They won't even have to manage it. That's the beauty of this infrastructure fading into the background.
So they don't need to understand liquidity pools.
Not at all. They just swipe a piece of plastic over a standard Visa terminal. Behind the scenes, it instantly liquidates into local fiat currency to pay the merchant.
And the merchant has no idea crypto was involved.
Nope. And the digital wallet can be set to automatically convert those reward tokens into dollars or roll them into an index fund.
Oh, wow. It's an open loop instead of a closed loop.
Exactly. When you have over $500 million a month being spent this way, the technology has successfully faded into the background. It's not about trading anymore. It's about seamless daily utility.
Man, it is incredibly clarifying to see all these pieces locked together. Let's synthesize everything we've covered.
Good idea.
If we zoom out, the noise of the week was definitely the panic over those short-term ETF outflows.
Right, the surface level price action.
But what truly mattered was this relentless push by institutions to tokenize real-world assets and build the payment rails to actually spend them.
Exactly. The signal is the infrastructure. And if you want to know what to watch next, keep a very close eye on those traditional regulatory bodies.
Watching them react to Coinbase exporting U.S. equities, right?
Yeah. That friction is going to be the defining battleground of the next 2 years.
It's going to be wild watching regulators try to put borders back up on a borderless technology.
It really is. And it leads to a final lingering thought that I want to leave you, the listener, with today. Something to mull over.
Lay it on us.
If traditional stocks live on crypto rails and crypto cards let you spend them instantly at your local coffee shop while earning on-chain rewards,
Yeah.
in 5 years, will we even use the word crypto anymore, or will it all just be called finance?
Wow. That is the ultimate question. Thank you so much for joining us on this deep dive.
It's been great.
We love unpacking these massive structural shifts with you. Be sure to follow Nifty Noon on X and subscribe to the Substack to stay ahead of the curve. Until next time, keep looking past the noise.